Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that reads like a financial thriller with a dramatic acceleration of a loan and some serious legal wrangling. Get ready for some twists and turns. Before we dive in, make sure you hit that subscribe button if you love getting straight answers from these massive corporate documents. You can also join our Discord community for more discussions, linked in the description below. We're looking at an 8K filing from American Strategic Investment Company. Now, this isn't a regular earnings report. An 8K is filed when companies have very big, usually sudden, important events to tell us about, and this one certainly has an important event. This report is all about a sudden acceleration of a major loan. It seems like a big debt problem has just kicked into high gear for them. The company is American Strategic Investment Co., or ASIC, if we want to shorten it. But they're pretty upfront about their name here. Incorporated in Maryland, they are a real estate investment trust, or REIT, which means they focus on owning, operating, or financing income, generating real estate. They have common stock out there, traded on the New York Stock Exchange under the symbol NYC. They also have something called preferred stock purchase rights, also traded on the New York Stock Exchange. It sounds a bit complicated, but often these are like special shares that give holders certain rights, especially if a company is taken over. Now let's get to the heart of the matter. This filing is about something called a triggering event that makes a financial obligation much bigger or due much sooner. Think of it like a clause in a contract that says if one thing goes wrong, everything is immediately owed. The situation involves two specific entities, Arkansas CNYC 400 E67 LLC, which they call Laurel Borrower, and Ark NYC 200 River, one LLC called 200 Riverside Property Borrower. These are subsidiaries of American Strategic Investment Co., the company. They are described as the borrower. The lender in this big loan is Societe Generale, a very large international bank. They originally took out this loan back in April of 2018. It was for a hefty $50 million. This loan was backed by mortgages on two specific properties owned by the company, one at 400 East 67th Street and another at 200 Riverside Boulevard. A non-recourse mortgage means that if the borrower can't pay, the lender can only go after the specific property used as collateral, not other assets of the company. The company's operating partnership, New York City Operating Partnership LP, also acted as a limited guarantor for certain parts of this loan. Now, things started to go south. The company was informed by a special servicer, Rialto Capital Advisors, that they were in default on this loan. This special servicer acts on behalf of the lender. These notices of default came in waves, starting in November of last year, 2024, and continuing through June of this year, 2025. The actual problems that triggered these defaults first happened way back in the third and fourth quarters of 2023. That's a long time between the issue and the formal notice of default. What went wrong? The main complaint was that the company failed to set up a proper cash management system for any extra cash they had after covering their monthly loan payments. They also apparently didn't work well with the lender to fix these cash management problems. And crucially, they started failing to make payments on the loan beginning in April of 2025. It is important to note that American Strategic Investment Company didn't just accept these notices. They responded and rejected the lender's claims in earlier notices. They clearly disagreed with the lender's interpretation of the situation. But then on the 6th of November 2025, the big one arrived. The special servicer sent a new notice detailing even more reasons why the company was in default. One of these new defaults was taking on other debts that were not allowed under the loan agreement. Think of it as borrowing money elsewhere when you promise not to. They also apparently allowed certain legal claims or liens on their property that weren't approved by the lender or considered permitted by the loan terms. This often happens when suppliers or other creditors aren't paid and then put a claim on the property. These new claim defaults stem from the alleged failure to make certain payments and the resulting liens on the property. It seems like a cascading problem. And here is the crucial part. The special servicer declared that due to these alleged defaults, the entire loan had been accelerated. This means the full amount of the loan is now immediately due and payable. So not only is the original $50 million principal amount due, but now interest at a higher. Default rate is also piling up. This default interest rate is pretty significant. It is 4% above their original interest rate of 4.516% compounded monthly. That extra 4% tacked onto that base rate compounded can make a debt grow very quickly. So we're talking about the original $50 million plus all this accelerated interest and fees. It's a massive sum that's now immediately owed. The company acknowledges they are looking at their options regarding the properties, and they are being very clear that there is no guarantee on how this situation with the lender will be resolved. This language suggests a very uncertain and potentially difficult road ahead. And at the end, we have the signatures, normal for these filings. This report is signed by Michael Lisanto, the Chief Financial Officer. Given the content of this filing, his role as CFO is certainly under the spotlight right now. Now, looking at this situation for American Strategic Investment Company, what we see is a classic scenario where a company's operational issues, specifically around managing its cash and debts, have triggered a severe financial consequence. What is particularly concerning is the gap between when the problems first started in 2023 and when the full acceleration notice came in late 2025. The company claims they rejected earlier notices, which suggests a disagreement on the severity or validity of the defaults. However, the lender, through their special servicer, seems to have built a strong case for acceleration, citing additional defaults like taking on unpermitted debt and liens. The acceleration of a $50 million loan with added default interest is a huge problem for any company, especially a real estate investment trust that relies on stable cash flows from its properties. The fact that these defaults are linked to specific properties means those properties are now at serious risk of being taken by the lender. The company's statement that they are evaluating their options, and the no assurance of resolution signals that they might be preparing for tough negotiations, or even the possibility of losing these assets. This puts a significant question mark on their future strategy and financial health. It is a stark reminder that even seemingly standard loan agreements can have severe consequences when breached, and proactive debt and cash management is absolutely critical for any business. Alright, that is our breakdown of American Strategic Investment Co.'s latest filing. It's a tough situation for them. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.